Good afternoon, ladies and gentlemen. My name is Edward Stone. I'm a Director of Research at the World Platinum Investment Council. The first thing on my notes is I've got a note here to thank the organisers for inviting me to speak. I think that's the purpose, since we are the organisers. But thank you to the other organisers for giving me a slot. Secondly, as Benny pointed out, this is the toughest slot in the presentation schedule. Just after lunch, everyone's feeling a little bit sleepy. Don't worry, my presentation starts slowly, and then the key message comes later on. Just asking the usual disclaimer: if you suffer from insomnia, please read your leisure. And then just a brief introduction to World Platinum Investment Council, or WPIC. Most of you will know who we are thanks to the sterling efforts of Wei Bin and his team here in China. But beyond China, we have been developing the platinum market through a number of partnership agreements with bench refineries and bullion dealers in Europe, North America, Australia, and of course in Asia. Most of these partners of ours sell physical bars and coins predominantly to a retail market. Including China, we now have more than 30 partnerships worldwide. As well as addressing the retail audience, we interact with institutional investors. We work to educate our product partners, sales teams on the platinum investment message, and give them a simplified message to provide to their own client ones. The feedback. Sorry, I'm skipping a slide here. I'm starting again. As well as working to develop the physical retail investment market for platinum, we engage with institutional investors around the world, providing them credible research to help them invest in physically backed exchange-traded platinum products. Our aim is effectively to increase information liquidity, to educate investors, reducing the barriers to entry, allowing them to make faster investment decisions regarding platinum. Our lofty ambition here is ultimately to get to the point where the majority of investors are not questioning whether they should or should not own platinum, but how much platinum should they own right now. So as well as engaging with institutional investors, we have education programs with our product partners, helping their sales teams to develop a simplified platinum investment message for their clients. The feedback from them is to keep it really simple. So we start off with a definition. What is platinum? Fundamentally, it's a method you can invest in. It's the rarest precious metal in the world, 20 times less availability than gold, 100 times less than silver. It's a store of value. It's got important industrial uses, and it's a critical metal for tackling the energy transition. Why invest in platinum? 3 simple reasons: strong demand, a shortage of supply, and it's currently undervalued. This slide just shows that graphically. So on the left-hand chart, you can see the relative availability of platinum compared to gold and to silver. On the top right-hand chart, you can see the effect of the ongoing shortage of supply. So on our figures, we've got platinum remaining in a continual deficit for the foreseeable future. That deficit is plus minus 500,000 ounces, or around 15 tonnes a year. And then in terms of being undervalued, the bottom right-hand chart just shows the price ratio of platinum to gold going back to 1880. And you can see since 1900, platinum has traded at roughly twice the price of gold, and it's currently trading at less than half the price of gold. These are all observations which we find resonate strongly with investors, particularly with the retail audience. Turning specifically to China. Now, China's demand for platinum has evolved quite significantly over the years. This chart shows the evolution of that demand on a quarterly basis since the third quarter of 2014. As you can see, demand for platinum in China has migrated from being dominated by the jewellery market to being increasingly influenced by automotive demand, industrial demand, and on the purple there you can see emergent investment demand. Clearly, the overall trend is for demand to decline in China due to the erosion of jewellery demand, but we think there are opportunities to recapture some of those. Looking ahead, the hydrogen economy is likely to be increasingly important in terms of the outlook for China's future demand for platinum. Platinum is a critical metal for use in the production of green hydrogen via electrolysis, and also through the usage of that green hydrogen in fuel cells. On our forecast, China is expected to lead the way globally in producing and using green hydrogen as part of the energy transition. By 2040, China's hydrogen-linked demand for platinum is expected to reach almost 25 tonnes per annum. That represents around 40% of China's current platinum demand. Added to this is growing investment demand, which has developed rapidly over the past 5 years. Again, very much reflects the efforts of Wei and his team here in China. Including all bars and coins, this reached 5 tonnes last year. We only publish in our supply demand estimates the numbers for small bars and coins, less than 500 grams in size, of which 2 tonnes are expected this year. That said, I should know that we are seeing a continued strength in demand, and there's plenty of potential for that number to be exceeded. Here you can see a picture of some of the available investment products. Of course, if you step outside the room, there are many, many more shown. And I think we're all agreeing that the quality of these products is exceptional. Some of them effectively almost works of art at their own right, as well as the contained value of the investment. Whilst investment demand is growing strongly in China at the moment, and there is significant potential for demand growth from hydrogen, these may not be easy to sustain. Indeed, we forecast China's platinum demand to grow by only 12% between 2023 and 2040. It's the relatively flat trajectory you can see on this chart. This is held back by a potential shortage of material due to a lack of domestic supply, which is effectively limited to recycling, which falls well short of meeting demand. So effectively, China doesn't have a material source of domestic mine supply. You've also got competition for material from the rest of the world, which is shown in the pink area of this chart, and you can see the growth in demand continuing in the rest of the world as well as in China. This results in the sustained market deficits for the foreseeable future, which I mentioned earlier. These deficits are expected to rapidly deplete above-ground stocks down to unsustainable levels. We define above-ground stocks as vaulted inventory, excluding ETFs, stocks held on exchange, and working inventory. The question you may be asking yourself is, why will mine supply react to deficits and offset the above-ground stock decline? Well, remember that developing new mines takes 8 to 10 years as a minimum, and at current price of platinum, palladium, and rhodium, there is no economic incentive to expand output. Indeed, the current most likely output is for production to be cut rather than expanded. So with no material domestic production, how can China protect itself from future supply risks and ensure it has enough of the strategically important metal to maximise its hydrogen potential? We think the answer is to build a domestic reserve of platinum, which could be in the form of jewellery or investment products that can be made available for future national needs. To grow this reserve, however, requires minimising transaction costs and improving market infrastructure to maximise metal flow. An example of this in the rest of the world would be the availability of platinum ETFs. Indeed, in the UK, over the course of the second quarter of this year alone, more than 500,000 ounces, or almost 16 tonnes of platinum holdings, were added to the domestic ETFs in just the second quarter of this year. ETFs work in the rest of the world because of the ability to manage price risk on behalf of the ETF issuers by hedging the futures contracts. The ability to manage price risks has broader impacts on the platinum market as a whole. It improves cost visibility for fabricators of jewellery and investment products, which in turn minimises required product premiums and the buyback discount imposed upon consumers. Similarly, the cost visibility helps domestic automakers and industrial end users with budgeting. In this chart, we highlight Chinese platinum jewellery demand and the challenges and how the challenges related to managing price risk have impacted that demand through time. During the initial pass of the 2000s, you can see that the demand for platinum jewellery increased pretty dramatically in China, ultimately reaching almost 2 million ounces a year on a sustained basis. Now, that was during a period of rising metal prices. And during rising metal prices, when you don't have the ability to manage price risk and you're having to do that with premiums and discounts, consumers are not overly impacted by that. When they come to a sellback, they're typically still selling at a higher price than they purchased originally, and that provides overall confidence in the security of the underlying asset class, in this case platinum jewellery, and continued investor demand for that, for those assets. However, you can see that when price begins to decline, for the fabricators to manage that price risk, they therefore have to offer increased premiums over the obtained metal product and increased discounts. And so that hurts the consumer company on the way down. And ultimately, it erodes consumer confidence in the underlying asset class, and particularly when you contrast platinum jewellery, for example, versus gold, where fabricators have the ability to manage price risk, and that allows them to minimise those premiums and discounts. And ultimately, that's resulted in China's jewellery market eroding from that almost 2 million ounces a year market down to only 400,000 ounces a year. So the ability to manage price risk, and with the potential launch of the Guangzhou Futures Exchange, physically settled platinum palladium futures, there is the opportunity to potentially recapture some of that 1.6 million ounces of lost jewellery demand. There is another factor to help improve the platinum market infrastructure in China. So that's the challenge presented by VAT and the question of it being non-refundable to individual sellers. As a result of this, the sellback of physical platinum by individual investors triggers a 13% VAT charge, which disincentivizes demand for platinum as investment or for platinum jewellery and risks outflows of platinum from China through artificial channels. In addition, the recycled platinum-based products sold by individual collectors also triggers a VAT charge of up to 13%, which hinders the growth of domestic recycling supply and also increases the illegal exports of collected and recycled platinum. Optimising VAT on platinum would have a number of benefits. So firstly, we put platinum on an even footing with gold. It would give greater consumer confidence to buy platinum products versus gold. It would increase the platinum buybacks through efficient channels and help keep metal within China. It would increase the competitiveness of Chinese industrial companies versus lower tax jurisdictions, an example of which would be the United States. And it would also increase metal flows, resulting in more job and tax revenues from both corporations and individual income taxes. We estimate that optimising tax and offering derivatives can significantly stimulate platinum demand in China, which would result in the build-up of a substantial domestic reserve of this strategically important metal. So in conclusion, securing a long-term supply of platinum for China and maximising the availability of PGMs within China requires minimising transaction costs through optimising VAT, improving market infrastructure through allowing derivatives, physical market liquidity and hedging through derivatives. And the benefits of this would be putting platinum on even footing with gold. It would increase the domestic holdings of this strategically important metal within China. And repair the broken link from platinum recycling and buyback, where that is not refundable to individual sellers. And would revitalise the platinum market, ultimately increasing job creation and increasing income taxes on a net basis, being of ultimate benefit to the exchange. With that, I'll thank you.